We're having a look at why the producer price index from the US is the most important economic data point today. And then we're going to move on to this whole situation in China and Taiwan now. Why have Chinese aircraft entered Taiwan airspace, and is it incitement to war? And then finally, for the trade and takeout, we're going to have a look at why you need to reduce your position size the second you feel unconfident. Now, the only way you can get the best trading insights, education, and analysis each day is if you're here every day. So hit subscribe so you can get your daily trading edge. So in front of me, I've got the US producer price index versus the US inflation rate. And to be clear here, it's the US headline inflation rate. Now, what normally happens is the CPI actually is before the PPI, before the producer price index. But today and tomorrow, we've got the PPI before the CPI. And if you can notice here, okay, the PPI tends to actually lead CPI. So you can see here it started turning and then CPI turned afterwards. So CPI is in orange and then PPI is in green. And over the last 2 years, the direction of PPI has actually been a predictor of CPI, the direction anyway. So basically, let's boil it down to this. If today we get a beat on the PPI, it's more likely, about 2/3 likely, that we get a beat on the CPI headline number tomorrow. Okay. So just make sure that that distills in your mind. And obviously, the other conditions go the same way. If we get it in line, it's likely CPI is going to be in line. If we get it below, then CPI is likely to be below as well. So it's quite a key little nuance here. And that's a massive, massive edge that you can actually exploit. And these are the kind of things that we really, really want to be paying attention to in trading, because if this becomes something that you can use over the next year, for example, you should only trade that genuinely, because that is a clear and defined edge right there. Now, it doesn't necessarily mean that, you're going to be able to really, really profit from it, because it will probably take some understanding of, okay, where do I actually enter the market? Or sorry, which asset do I actually enter the market on? Would it be on gold? If you're making a play on real yields changing, would it be perhaps on the dollar, which is probably my preferred choice on this, to be honest, if it were to influence what the Fed does? Or would it be on equities even? If you do get a beat on the PPI today, you probably want to sell equities, especially after a little rally that they've had actually. So that could actually be, one of the key assets to look at. If PPI beats today, does equities sell off? So yes, this is the way that I would look at it. Choose your asset selection carefully. If you were to look at this as, developing an edge, this doesn't happen too often though, the PPI before the CPI. So it's definitely one to watch over the next coming months as well. So right here is a perfect example of, using hysteria to your advantage. So every single month, Chinese aircraft enter Taiwan airspace. And every single month, it's reported as being, a declaration of war, when it just isn't. They've been doing this for years now. It's probably just, at times when there are more maybe provocations going on in terms of, what politicians say, that this gets reported on more. But it's a nothing story. But what you can do is, whenever you see people talking about this, you can make a note, okay? Because clearly they've got a blind spot. They're not understanding things. They're not putting pieces together. So whether it's a journalist, whether it's someone on Twitter, whether it's someone on social media, it doesn't matter. You then want to analyze exactly what they say going forward, because they don't actually understand what they're talking about, and they don't understand context. They don't understand how to put things together adequately, okay? And these are the things that we have to try and spot, because I'm not a quant person. I don't know how to do fancy maths. I don't know how to look at loads of different numbers. But what I do understand more is people. I have quite a good grasp of people and how to use and view their weaknesses and in their analysis to my advantage. So, for example, previously I've spoken about sentiment, for example, when it comes to looking at retail trading books, brokers provide the sentiment. You then can make an educated bet on the type of counterparty that is trading there and where they might be completely stuffed based on the extent to which people lose at retail brokerages. So it's, I don't, maybe it's called social engineering. I don't know. It's probably not. That's probably the wrong definition. But you're basically looking at where people's blind spots are and where then the risk to reward might be in the market. And, the more that people talk about Taiwan and China and a lot of geopolitics when it relates to the markets, actually, the more blind spots they're able to show of themselves. So definitely make use of other people's lack of knowledge or lack of understanding. It can really go a long way. So today's trading takeout is why you need to reduce your position size the second you feel unconfident or have a lack of conviction. And I say reduce position size and not just step out of the market, because stepping out of the market doesn't let you learn anything. I always think that whenever you want to learn something, you have to put yourself out there. Or, in a trading context, you have to put on risk. And it doesn't matter the amount of risk, because even putting on the smallest size onto a trade will let you learn something more than just being out of the market. Okay. As long as you're not going to blow up on a trade, fine, be in that trade, in my view. But don't be in a trade where you feel completely uncomfortable or you just don't really think that the market is doing what you like. Because what happens when volatility changes is your thought processes change. Your reasoning for taking a signal and remaining in a signal changes. But also when volatility ticks up, your signal shouldn't decay very quickly. Your signal should decay quite quickly. So you should get a response time very, very quickly as to whether your signal is right or wrong. Okay. So really, really focus when you're seeing volatility ticking up on maybe drawing back, but not stepping out of the market. And then timing, I guess, how long your average signal is taken to come to fruition between a market that is flat on volatility versus a market that's seeing spike in volatility, because again, that can really, really help.